So, look, we've got some good attendances coming through, and I think that's a testament to the fact that it's a very topical subject at the moment. I don't know if people have heard today, but down here in Victoria, we've got 723 new cases, and obviously there's a lot of uncertainty in the marketplace. Just some housekeeping to start. What we'll be doing is we'll be recording this session, and I'll later be posting it on my website, which is ascentpartners.com.au, and we'll also load it on the Visual Connections virtual trade show site. They're running a virtual trade show until the end of September, so you can jump on and see it there as well. Down the bottom of your screens, you'll see Q&A. So during the presentation, if you'd like to ask any questions, please type those in at the bottom there, and we'll address those either during the presentation or afterwards in the Q&A session. So what we're going to talk today about is the current state of play in the marketplace. I'll be talking about the different market sectors within the printing industry and what's happening to each of those individual sectors. I'll then be talking about the grants that are available at the moment, specifically the new grants, JobKeeper 2.0, and some announcements from the Fair Work Commission. Andrew will be talking about some insolvency laws that have been going over COVID and what the current laws are. And Wade will be talking about the situation with regard to finance. We'll then move on to the planning stage, and we'll talk about the need to be able to plan objectively. And Andrew will talk about the insolvency decision tree. We'll then move on to the various options that people might like to consider. One is the regroup option. There's a lot of options within that particular option. One is to stay as is and to right size, and others include being able to downsize, being able to collaborate, and being able to merge. I'll then talk about the business sale option. Some people might need to bring that forward, and then Andrew will talk about the closing option and what's available there. So just a bit about us. Firstly, myself, I'm a director of Ascent Partners. We started in 2007, and basically our business is built around the printing industry. That's the only industry that we service. We do business appraisals, business valuations on a national basis, and we help people sell their businesses or be able to help them acquire their businesses. As a result of that, we also help people dispose of some of their plant and equipment through our classified site, which is printmachinery.com.au. Wade, you might like to tell us a bit about what you do.
Yeah, thanks, Richard. Look, I've initially had a commencement in this industry in 1985, starting my own business in 1995 when I could perceive some problems within the banking sector and their dislike at the time for printing industry, and took that on my own to push forward because I had a different view. These days, as the printing industry has reduced, so has my dominance on the industry. I've had to move into other sectors to remain viable, but I still represent customers nationally, and still have a lot of support and referral coming from vendors of machinery, both new and used. We tend to look at businesses up to about $30 million turnover, from quite small, and look to not compete with the incumbent bank, but add value. By that I mean your incumbent bank is quite often secured by real estate providing working capital facilities. The finance we use is through tier one banks, but it's equipment finance secured by the equipment itself rather than by property.
All right.
Over to you, Andrew.
Good afternoon, everyone. My name is Andrew Barnden. I'm a director of the Sydney office of Rogers Reedy, which is a specialist accounting firm specialising in insolvency, forensic and reconstruction. I've over 20 years insolvency and reconstruction experience and have dealt with numerous matters over the years in the printing industry. Rogers Reedy is a national or international firm, but we have offices in every state in the Northern Territory. And with the current border closures, that is of a big assistance to us to allow us to deal with our clients and assist them in these interesting times that we live in.
All right, thanks for that, guys. What we might do is just launch a poll just so that we can, when we're going through the presentation, we can actually tailor it to the market sector that we're addressing. So I'm just going to launch this poll. You should see that coming up on your screen now. So if you could just check the box that best describes what industry sector you're in from A3 offset trade suppliers. I can see those flicking off now. That's good. I'll just give you a couple of seconds to complete that. Yeah, we're just about done, I think. Yeah, so we've got 80% have voted. That's good. So I'll end the polling there and I'll share the results there. So basically, a third of you are in the A3 offset area, offset digital area. 22% are in the A2 area. A couple in the A1. We've got wide format and screen. We've got labels. No one in the packaging area. We've got a print broker, trade suppliers, and we've also got some others. So that's good. We've got a pretty good cross section. So what I'd like to do now is just talk about the current state of play with regard to the market. About 6 weeks ago, we did a survey and most of the respondents were commercial printers. Basically, 2/3 of them said that they, over the 6-month period from April to September, they expected to be about 50% down in sales compared to pre-COVID levels. With regard to print franchises, there are about 400 of those around Australia. The feedback we're getting is that in April and May, they were about 60% down in sales. Trade finishes are pretty much in line with 1 and 2, although I suspect they're probably down a little bit further, mainly because commercial printers and franchises are doing more work in-house that they'd normally send to a trade binder. Wide format, we launched a survey in the trade journal Wide Format Online last week. We haven't had a lot of response to that, but it seems that wide format was very similar to commercial printers, down about 50% in the first few months, but they seem to be forecasting that they're going to improve over the next 4 or 5 months. But it's a very wide segment, so different parts within those segments are doing better or worse than others. The out-of-home segment, it was reported in the trade journals that in Q2 of this year, they were down 65% compared to calendar year 2019 Q2. In the newspaper market, the trade journals have all been reporting some major changes, specifically with News Corporation. They've closed down a number of titles, I think about 120 or so. And there's talk about closing of the major plants, or some of the major plants, specifically up in Queensland. The catalogue market was down 70% in April and 55% in May. We think that's improving a bit, but there are two major players in that area. One is IVE and the other one's Avato. And if their share price is anything to go by, I think Avato's share price is currently trading at about 1 cent, which gives them a market capitalisation of about $8 million. And for a firm that was doing about $1 billion worth of turnover about 8 years ago, that's pretty disastrous. With regard to magazines, they're significantly down. Most of you would have read about the sale of Bauer, which is the publisher of, I think, of about 60% of Australia and New Zealand's magazines. That was sold, I think, for a reported $40 million. They purchased that business in 2012, I think, for $520 million. So they're closing down a number of titles in that segment as well. I think probably the standout performer is basically in the labels and the packaging area. They're faring a lot better than the other market segments, and specifically those that are related to the fast-moving consumer goods market. They actually had a bit of an increase at the start of COVID when there was a rush on the supermarkets. Also in the trade journals, we saw that the paper imports were down 30% in April and larger falls were expected in May. So all in all, it's been a major upheaval to all of the markets, really, maybe with the exception of some of the people within the labels and the packaging area. We certainly haven't seen those levels of falls in my lifetime, or I don't think ever in, you know, the printing industry. And I guess that begs the question, if that's what's happened in the last few months, what do we expect is going to happen in the next few months? So again, I'd just like you to participate in the poll, and I'll get this. Let me just get that. Stop sharing results. And we'll go to poll 2. So this poll is basically about what people think that their sales will be over the next 5 months. And it's basically compared to the pre-COVID level of sales. So if you could just enter those into your responses there. See them coming up. We've got most of the people have responded. Okay, so that should be enough time. I'll end the polling and I'll share the results with you. So that's basically saying that for the next 5 months, most of them are expecting sales to be down 20 to 40%. So 17% down from 40 to 60%, and 6% from 60% or more down. So there's only 6, 9, 12% think that they'll be flat or less. So it's more of the same, although it seems to be getting a little bit better. I'll just close that now. Okay, so last week, JobKeeper 2 came out. So they made a couple of fairly significant changes, and there are two extension periods. One's from October to December 20, and the next one's from January to March 21. So sales need to be down 30% for the first part of it in the June and the September quarter. So it's important to note that it's and. So the June quarter of this year compared to the June quarter of last year, September quarter of this year compared to September of last year. Both of them have to be down 30% to be eligible. And the same thing applies to extension 2 from January to March 21, but that also includes the third quarter, which is the December quarter, also needs to be 30% down. So they've tightened up on that quite a bit. The other thing that they've changed is they've changed it to be a 2-tier. So we've got full-time employees. They're up to, they're currently $1,500 per fortnight to the end of September, then $1,200 per fortnight to the end of December, then down to $1,000 to the end of March. The other change was with, or the other tier was that they introduced the part-time tier. Now that's for people who on average worked less than 20 hours per week in the month of February 20. So for those people, they'll get $750 to the end of December, then $650 to the end of March, again against this eligibility criteria of 30% down. The other change was with regard to job seeker. So job seeker is $550 supplement to the end of September, then $250 per fortnight to the end of December. There's no announcements that have been made post December this year. Now, the government thinks on a national level that the unemployment level will peak at 9.25% in the December quarter. So they're actually saying that they're thinking that there's a lot of people that are going to be going from job keeper to job seeker in the next few months. There's obviously a lot of grants that have been available. There was the first one, which is the GST credits, and there's state grants. For example, here in Victoria, there's a $5,000 grant that was just announced for the second lockdown. With regard to job trainer, in July, the government announced that they'll pay half of the apprenticeship fees or half of the apprenticeship wages, and they'll subsidise the education fees as well. The government at the start of COVID said that, tenants and landlords should get together and work out a deal for their rentals over the COVID period. And the same thing with regard to other creditors. People have been able to seek lower repayments or term deferments on their loans. The Fair Work Commission also announced, I think in June, that they would be delaying the minimum wage increase to the end of November. So that's the current state with regard to the grants. I'd now like to hand over to Andrew, who's going to discuss what's happening with regard to the insolvency section.
Thanks,
Andrew.
Richard. So the first thing we're going to look at is the ATO. So someone's got to pay for all these grants and that's been going out, that the government's been handing out, JobKeeper, JobSeeker. However, that's not going to happen for a while by the looks of it. The ATO's official statement is that it's working shoulder to shoulder with businesses. And my understanding is that the ATO enforcement and recovery teams have essentially been put into hibernation, as most of those staff have been outsourced to other areas of the ATO. Just noting that the ATO used to be one of the most aggressive creditors in the marketplace, especially in the winding up sector of companies. In our data, the Rogers Reedy puts out a daily risk watch reporting the activity in the courts in the general winding up area. In May, there was only 2 winding ups issued by the ATO. Traditionally, they're in the around the 50 plus mark. And in June, there was no winding up application. So that is a big interesting factor there, that it is just kicking the can down the road for the ATO and is bringing into this sector what they call zombie companies. Just note in mind, even though the ATO aren't pushing people, you still have to pay your superannuation on time. And that's causing a bit of a cash flow problem for some people, because the JobKeeper is the $1,500 has to be passed on to the employees of full, but you still have the 9.5% super you've got to find to pay on top of that. And don't forget workers' comp and payroll tax. I know a lot of the payroll tax across the state have been put on hold also, but these things are all things that everyone needs to take into consideration. In addition, back in March, there was some significant legislative changes, admittedly only temporarily, they brought in, which has also seen the number of insolvencies reduced significantly. So they increased the minimum amount for a statutory demand and bankruptcy proceedings go from $2,000 and $5,000 respectively up to $20,000. Previously, you could issue a statutory demand against someone for $2,000 outstanding if it's a corporate matter, or $5,000 for to commence bankruptcy proceedings. That's if the amount outstanding to you was in excess of that. So that went up to $20,000. That's due to expire in September, but there's been no talk about whether that's going to be permanently or extended or further extended out for another 6 months. It's more watch this space. And similarly, the statutory demand and bankruptcy notices, the time period to comply with that has increased from 21 days to 6 months. So that's also seen a big drop in statutory demands and bankruptcy notices being issued, because people have seen little benefit in filing those applications if they've got to wait 6 months for them to actually then move on to the next step. There's also temporary relief for the directors for their personal duties to prevent debts being incurred whilst they know, or reasonable persons know, that a company may have been trading insolvent, although this has been carved out in the ordinary course. So generally, if a company's director knew or ought to have known that they were digging a bigger hole for themselves, they can lift the corporate veil. If a liquidator is appointed, they can lift that corporate veil and pursue the directors personally for these debts. But during this period, 6 month period, if it's incurred in the ordinary course, their insolvent trading relief is granted to the directors. So, but that again is due to expire in September, and at this stage there's been no update as to whether that's going to be extended or whether it's going to drop off at that time. Just noting that there's also been various industrial relation laws eased, especially in respect to standing people down and unfair dismissal on restructuring. And again, that varies from state to state. And again, there's no update as to whether they're going to be tightened up again moving forward. As I mentioned before, the ATO hasn't been a major player in the winding up proceedings at the moment. And generally, we're finding a lot of people kicking the can down the road and waiting to see what's going to happen, waiting to see what happens with JobKeeper and whether they can still continue to survive after that time. From the same time as last year, winding up and companies going into external administrations are down 70% from what it was last year. Generally, there's about 2,000 companies going to external administration each quarter. The last quarter ending June showed there was a bit over 400. So about 23%, I think it was, had entered into compared to the same time last year. So that puts out there 1,600 companies that would have gone under in the ordinary course are still out there. That's before we even add COVID-19 into the situation and how their business has been affected by COVID. And this is bringing into the media what they call the zombie companies and the wave that might be coming through once all the government assistance comes through, stops, I should say, and whether there's going to be a backlog of, by the end of September, of 3,000 or more companies that need to be dealt with in one way or the other because they can't deal with their debts as and when they become due and payable. I might just move on to the next screen. Thanks, Richard. So that's what's changed. Now, what hasn't changed? So directors, the ATO director penalty notices, even the ATO is not actively pursuing them, but they can move back and retrospectively lodge a notice at any time. And previously, it used to be directors are personally liable for superannuation and POIG, but since the 1st of April 2020, directors are now personally liable for GST obligations if the ATO issues a director penalty notices. That was as part of the anti-phoenixing legislation that was put through late last year, which had an effective date of the 1st of April. So keep that in mind about lifting that corporate bail in any personal exposure. There's no rhyme or reason whether the ATO will issue these notices to directors from my experience. However, there is a potential that they can come back against you for those debts being incurred by the company. Note non-bank security arrangements. While most of the major banks are playing by the rule books with what the government wants, especially after the Royal Commission, and are not enforcing and actually giving repayment holidays, noting that the capital, the interest is still capitalising, so the banks end up making more money out of that in the long run. You've still got to pay back the debt. There's been a fair bit of movement in the non-banking sector, enforcing their rights and putting a lot of pressure onto the various parties to keep up their payments or to refinance or have the threat of an appointment of an insolvency practitioner as a receiver and manager over or controller or repossessing their goods. So if you're not playing in the major banking sector and got money out due to a lot of private lenders or third and fourth tier lenders, be very careful. They are going through their books with a fine-tooth comb, and don't be surprised that they are calling up payments on you, even though on the other end of town, the major bank sector is being generally relaxed to most of their customers. However, there has been a lot of press, especially from the ANZ and NAB, saying we can't support unviable companies and we won't be there to save every company as we come out of COVID-19. Note also there's bankruptcy in the company winding ups that were commenced prior to the 25th of March are still ticking through the court system. So that there are still going to be companies going under a bet on a lot lower number, but there are still ones going through the system at the moment. So if things are on play before the 25th of March, they still can proceed. And also, even though the laws have been changed about insolvent trading and winding up applications, directors, there's been no changes to directors' general duties under the Corporations Act to act in good faith with care and diligence. So keep that in mind, that even though insolvent trading is maybe pushed to one side, your general director's duties are still active and you still have to meet your obligations under the Corporations Act. So Richard, I might hand over now to, I did mention some finance in the non-banking sector, and I'll hand over to Wade to give us his insights into that area.
Good afternoon again, everyone. Look, the banks have been very good in coming to the party with payment deferments back in March, April, when business pretty well fell off a cliff. They've all taken a slightly different view to it. Some banks have said you can have a 6-month full deferment and they're non-negotiable on that. Others are saying you can have up to 6 months and are negotiable as to when you wish to recommence your payments. I'm not terribly sure what's going to happen to those banks that say you're out for 6 months, because there's going to be people that don't want to accrue the interest, as Andrew had mentioned before, it will be, or it could be quite expensive. My experience with most of my clients are that either they didn't take any payment deferment or they commenced the payment deferment, and after a couple of months, a few months, when they started to understand what their cash flows were doing, they looked at it and said, look, let's start the repayments again, and thereby minimising the amount of accrued interest that's going to apply to those loans. There is, and of course that deferment is, or the initial deferment is due to expire from those who first took it in March. It will expire in September. Some others, if you're applying, if you applied in June, you would get the 6 months deferral to December with some lenders. Others would say, no, it was only for 6 months from March to September. So it's a little bit all over the place, a bit of a guessing game with the tier one banks. I suggest the best thing is to use a finance advisor that can find out for you and better understand it. There is a possibility of a further 4-month extension from September on loan deferments, though that has yet to be confirmed. And also, again, I remind you of the accrued interest. That can be a substantial amount of money depending on when you took the loan out and what the term of the loan is. By example, if you took a loan out in January of this year and you deferred your payments in March, the accrued interest is going to be substantial because interest is paid on a monthly reducible basis. If it's not reducing and in fact accruing, you're going to be paying a substantial amount more for it. In generally speaking, consistent with the loan deferment, be it 3 months, 6 months or whatever taken, the banks are adding those months onto the term of the loan, extending it by that number of months. I had a circumstance with Westpac recently, or in the last 2 weeks, where I'd asked to recommence payments and they said, no, we can't do that. And one of the problems with the deferment is that if a business wants to subsequently go and borrow money to buy another machine, the banks are refusing credit where they're deferred on any payments. And my question to Westpac was, well, hang on, you're making the client defer for 6 months. It's not his request. And in the other hand, you're saying, no, we're not going to give you any money. Time's out on that one at the moment. I've been waiting 2 weeks for them to get back to me with a workaround to find out how it's going to happen. So that's kind of a work in progress. I think the fact with most of the banks are that this caught them all by surprise. It is very much a learning curve for them, and they're having to restructure their people from certain divisions, similar to what Andrew mentioned with the ATO, into these deferment areas to try and understand how to work it and fix it. In deferment, the banks are being very helpful. In new loans, they're being quite disruptive. Approval times have stretched out. We used to be able to turn around a $500,000 loan in a matter of days. The loans now are not being picked up for assessment for between 3 and 7 or 8 days, depending on who the lender is. That's a knock on where they've moved their staff out of the credit area into the loan deferment area, which is obviously a new department. So expect to wait a little bit longer. The other things that have changed, there used to be auto approval on motor vehicles. If you've been in business 2 years, held GST registration 2 years, and had a good credit rating, you want to buy a motor vehicle for $100,000, you just you get it straight away. That has now been reduced to about 50,000, and full assessment can and often does apply for something as simple as a motor vehicle. So they're a bit harder there. Again, depending on the amount of money you want to borrow, but basically above $200,000, banks are requesting you provide your ATO, income tax account portal, and integrated client account portal. They inspect those to find out your state of play with tax, whether you're up to date, whether you're a perennial slow payer, or indeed you may have an arrangement in place. If you're a perennial slow payer, or you have an approval, you have a payment plan in place, the likelihood of you being granted credit is pretty low from a first tier lender. When I talk first tier lenders, I talk in the 3 to 5% interest rate area. Tier 2 lenders can be in the, let's say, 8 to 13% mark. So it's quite a significant difference. With ATO, quite often your accountant has been the first to jump in and say, look, you've got a payment problem with that. That's okay, I'll fix it. I'll just get your payment arrangement going. That's a short fix and a very short fuse. So I highly recommend you don't do that. ATO charges 12% on those loans in any case. Essentially, they are loans, quasi-working capital. There are what they call fintech businesses at the moment. They provide unsecured loans, some of them up to $400,000, most of them about $250,000. They're generally repayable over a maximum of 2 or 3 years, depending on the lender, and they will charge an interest rate in the order of 15%. Sounds like a lot of money when you just finance your car at 4%. I get that. However, it's a way forward for your business to continue to trade, pay the ATO on time, and be able to continue to invest in equipment in your business. Next page, Richard. The old Benny Franklin, failing to plan is planning to fail. I think we're all guilty of that at some point. What I'm talking about here is you understanding your business and being able to transmit that information to a bank or a finance broker so that they can work with you to be able to source funding for you. Knowing who your key customers are, the percentage of spend that they may have had of your sales in the last 12 months, talking to them about their forecast position. We all know that everybody fell off the cliff in March and April. Most of my customers are reporting that from an instant 60% decline, they're now back to maybe 20% under same time last year. And that's being supported by either JobKeeper or by reduced staff numbers, which have just transitioned over the last 12 months. Understand what your customers are going to spend, ask them. It helps you try and work out where you're going to be. One of the questions that we get from the banks at the present time when making finance applications, obviously, how has the client coped with COVID-19 and the downturn? So we talk to you about that sort of thing to be able to give the bank the information that they want and the level of information that they need. And by that I mean you don't tell them too much, you tell them what they need to know. Revise your monthly turnover and break-even point, which is kind of a knock-on from the above point where we talked about JobKeeper and when that reduces in October, where that's going to be, how does that change your break-even point? Consider your staff numbers and the cost of redundancy. If redundancy is of consideration because you're looking to resize your business, staff numbers are an important part of that. It's probably best to do the redundancy sooner rather than later, because the longer your employee is on the books, the greater the payout they will receive from you, and you've got to have the money to do that. Having realistic plans are highly respected by banks and financiers at the present time. They want to know what you're doing, where you were last year, and what you're doing. I've had customers that have divested their product niche, gone into different areas, and have indeed transitioned into those areas over the last 12 or 24 months. Others have found great little niches in the last 3 or 4 months that have given them a real boost. Include in your looking into your financial situation, having noting the savings that you've been able to make within your business, you know, in what your expenses were last year and what you're now making them. What are those savings? How have they been achieved? Have you got any new key customers, new products you're offering to the market? Has your business changed in some way, or are you intending to change it with the acquisition of new equipment? And what is the background of your investment decision to be able to invest in new machinery that might be a little bit left of field of what you're currently manufacturing? Lastly, if your forecast does not show a profit, and I'm suggesting just reality is a primary thing here. You don't start at the bottom and work your way up. You don't start with, I want to make $100,000 profit and then work your way up to what your sales need to be. You need to have a two-pronged effect. You need to go up and down, starting at where your sales are. And if that's back to the points above, what's your monthly turnover, what's your break-even point. If you've got a problem with profitability in that regard, it's really time to talk with professionals, be it your accountant, your finance broker, or in some cases your lawyer. Is there another page, Richard?
There we go. We're on to Andrew.
Not me. Okay.
Not you.
Thank you for listening.
Thanks, Wade. That ties in very nicely there, your decision tree model. And after you look at your current position, work out what you can do. Since the beginning of COVID-19, I've been advising lots of people to come in and see me and tell them to prepare a budget, work out your cash flow, both on an optimistic, pessimistic, and most likely basis. The cash flow from that budget you prepared last year probably won't be the same as this year because of with changes in sales, changes in income, but particularly in respect to a lot of additional costs, whether that's additional cleaning costs, changing in staff numbers, and how that's all working through. So have a look at the budgets and make sure they're flexible to allow for variances, especially if a second or third wave comes through, and Victoria's currently seeing that second wave. So this decision tree is a very good way just to put it out there for people to work out what they want to do. First thing is tally up your creditors. Work out whether they can be managed or not. Who are your creditors? What are the repayment terms? It's a very simple thing. If they can't be managed, then you've got to swallow the hard pill and look at appointing an external administrator to protect your own personal position from personal liabilities and breach of directors' duties, and also dealing with creditors. Is it a possibility to do a voluntary administration and DOCA process where you make a proposal to your creditors, come out a leaner, stronger business, or is it too far gone and do you have to put it into liquidation? Alternatively, if they can be managed, communicate that with your creditors and how they're going to be managed. Prepare a cash flow, how you're going to meet these payments. Is it Are you going to meet them in the ordinary course? Are you going to clear the small creditors first? Are you going to enter into installment arrangements? But communication is key, to be putting out there, communicating with your creditors what you're trying to do. Is it through government assistance that you're going to be having additional cash flow and it's just a timing issue, especially with JobKeeper that's coming in at the beginning of each month after the previous months you put out the wages? Is it through an improved learning and business efficiencies that you've been able to implement in the current environment? Or is it by, like I said, a payment plan? Can you negotiate with your trade suppliers? It might be putting in the old debts on hold, but paying for the new debts as they come through, new supplies that you're getting. There's no point working it out in your head and saying, I've got a plan, but not communicating that, because you might see your suppliers not willing to come in and supply you moving forward. So keep them informed. Keep your key stakeholders informed. That's everyone from your suppliers, your bankers, and even your employees. They want to know what's going on, and keep them informed. And if the plan changes, keep the plan updated and communicate that plan through. Try to renegotiate if things don't go the right way. And if that doesn't work, you might end up going back to step one and starting the whole process again. I might just move on to the next page, Richard. In these uncertain times, cash is king. I can't stress that enough. A former colleague of mine had a saying that turnover is vanity, profit is sanity, but cash is king. And that's more than relevant now. You've got the cash to pay out your creditors. There are good business opportunities out there, and it saves the stress for you trying to deal with these creditors. But consider, if you are going to pump in extra money into your business to keep it afloat in the short term, go to someone like Wade to get a second mortgage on your house. Remember, business must be profitable before it can generate a surplus to meet old creditors or to repay that new capital injection that you're putting in. There's no point putting in $100,000 or $250,000 in from a second mortgage if it's only go break even. You're going backwards personally. Also remember, it will take time to return to profit, and that's a moving feast. I gave this presentation back in May, June. Numbers were COVID-19 was coming down, looked like Australia had got on top of it. Second waves hit, especially in Victoria, and that's rechanged your modelling and your forecasts. In that regard, when this all started, I had a look at the Spanish flu, which happened in 1918, 100 years ago, as a good example of what COVID may relate to. Back then, it lasted for 2 years, and they actually had 4 waves. And the second and third wave was worse than the first. We're probably in the second wave now, and that's true. The numbers coming out of Victoria are worse than what the whole nation had around wave 1 of COVID. And don't be surprised that wave 3, if that comes through, are just as bad. So I'm not giving any good news there, but if history repeats itself, we're not out of the woods yet. Remember that profits will also have to be reinvested in the business till the old debts are cleared. And then don't forget, there's probably capital improvements on machinery and new things coming through. So any capital injections that you're putting in to the business will take a long time to get repaid. So keep that in mind when you're coming to this decision tree of what you want to do with your creditors and how you want to move forward. And that's only financial impacts. Don't forget the mental stress and the stress that's putting on yourself, your family, and even your employees and colleagues about these uncertain times. And is it all worth the stress? That because you may have 6 months of stress and have not progressed at all. So keep that in mind, whether it's all worth this in the long run, especially at home and on your personal side of things. But saying that, there are some positives. This has been a great time for people to put forced learnings upon themselves and consider where they can save money, have a ruler line through the books and run a ruler over it to see is there potential savings? What can we do to improve things? Can we consolidate? Can we look at reducing costs? I also tell people, look at your pricing and your sales. Are you going to lose people if you increase your prices by 1% or 2%? That increase in sales revenue can have a dramatic effect on the bottom side and the profitability. And in this reduced market, and how loyal your customers are, you may be able to increase prices to include some of those overheads that you've to cover some of those overheads, and reintroduce any overheads slowly that you've been putting, that you've managed to save, such as interstate travel, or reducing capital expenditure on new vehicles or new equipment. Just slowly look at whether you want to reintroduce them now or down the track, and keep that all intact so that you can look at what you're doing and keep your business profitable moving ahead. Also, consider your staff. You might be considering whether you need all your staff. Wade mentioned if you had redundancies, look at doing them sooner rather than later, because that may because that stops the crewing coming through, especially if you've got anniversaries of staff coming up. That could tip them into another few weeks of entitlements that they're due. But also on the flip side, staff are often your biggest asset. So look at their qualifications and the licenses of your staff, and do you need them just to run your business? Do certain people have the contacts, all those qualifications that are essential to your business, and without them, you don't have a business, or your business will be significantly hampered. So look at whether you want to restructure your business, take on some forced redundancies to come out the other side as a bigger, stronger, leaner business, especially looking at JobKeeper going to be reduced in September, post-September, and also again post-December. That's keeping a lot of people afloat at the moment. But with the reductions in that, consider whether you're going to be viable moving forward. So keep that all, putting that all into the mix and doing these budgets, flexible budgets on a pessimistic, optimistic, and most likely scenario, so that you can communicate with your creditors what your plan is for survival. If you can't survive, look at biting the bullet sooner rather than later to save that stress and anxiety that you may have, or look at selling the business and getting out whilst you can. Now hand over back to you, Richard.
Thanks very much for that. Yeah, we're now back to Victoria. 723 cases today. Fantastic. So when I ran the survey before, we said there was about 70% of people said that they'd be trading, or they thought they traded about 20% or more less, 20% less sales for the next 5 months as opposed to pre-COVID. So the first option to regroup is to right size. The first thing to do there is to be able to have a look at your GST sales. I saw there was a question came through about what the sales were. It's your GST sales that they basically compare. So compare those, find out what you did in Q4 FY19, Q1 FY20, and Q2 FY20, and compare those to the corresponding quarters, Q4 FY20, and the forecast sales for the next couple of quarters, because that's going to tell you whether or not you're going to be eligible for the JobKeeper in the 2 next stages. Then, as the guys were saying, you know, a lot of this, if your sales are down to that extent, something's got to happen to the workforce. And so you've got to plan your workforce according to the sales forecast. And if you're on the JobKeeper, you might be able to manage that by reducing their hours and still being able to keep on the same amount of staff, or you might choose to make a few of them redundant. And as Wade was saying, we really need to know what those redundancy costs are. So if you don't know what they are, it's obviously a very good idea from your cash flow perspective to find out what they are and then work out if you've got the cash to be able to afford those redundancies. Also need to forecast the other expenses for the next 6 months or so. Forecast what's going to happen to your rent with your rent catch-ups if that's applicable, and the same thing with regard to your loans. As Andrew was saying, we need to be able to model the cash flow and do it as a best case, worst case scenario. The other thing that I think is going on at the moment is the margins are coming down, unfortunately, and part of the reason for that is more people are fighting for the same print jobs, so prices are coming down. You've then got to ask yourself the question: are you profitable over those periods, and are you building cash? And also, are you able to reduce your debt? Are you building on the staff entitlement payouts, for example? Are you building on the accrued interest of the loans, etc.? And then get the crystal ball out, if you like, and say, well, post-March 2021, assuming there are no more grants, with the new level of sales, if they are going to be 25 to 30% down, do you have a sustainable business model? And do you have a positive cash flow? And do you obviously have a profit as well? So those things will basically determine if you're able to right size the business. The other thing that you might like to consider is what's happening to your machinery utilization rates. Because if your sales are down 20 to 30%, and say, for example, you're a B2 printer and you've got a B2 press that's currently working at 70% capacity, well, now it's only working at 40 or 50% capacity. And you've got to do the sums and work out whether or not you can actually justify having that press, or, you know, the pre-press arrangement in a place that you've got with those reduced sales. So for those of you that might not be able to right size, one of the alternatives from there is to have some major structural change. And this is hard to do, in as much as that it does require a lot of change, and some people won't be able to get their head around the changes that these next 4 or 5 points need to happen. The first thing is with regard to downsizing. So as I was talking about before, with a B2 plant, for example, you might find that your B2 press is now only at 30% capacity. So you might be better off to be able to downsize and just stick to the A3 sheet size, for example, and outsource the B2 work. I've got one client at the moment that's doing exactly that. So they're selling off their B2 plant, and they're going to focus on A3 A3 manufacturing, and they're going to outsource their B2 work. The other next stage down from that is to completely get out of the manufacturing area and to print broke or to print manage. The other thing that you might like to consider is to be able to collaborate with another printer. And some examples of how that might work. Just say you're a B2 printer, you're turning over 3 million pre-COVID, and now you're turning over 2. You might have a printer around the corner that's doing the same. Well, it makes sense that you're only using one set of plant and equipment. It makes sense that you're only trading from one set of premises. So it might mean that one firm moves in with the other firm and continues to trade as Bloggs Printing, and they continue to trade as Smith Printing, but you utilise the same plant and equipment. So things like that will obviously make it a better, more sustainable business model. And, you know, the same thing would go for an A3 printer, where you might be only doing $1 million of sales and the guy around the corner is doing $1 million, and now you're only doing half of that. Because realistically, with the volume of sales that have fallen off, if it's across the board 20 to 30% down, we only really need 20 to 30% less printers. So there's room in the marketplace, I certainly think, for people to collaborate with each other. The next step down from that is to actually merge. Now, the merging means that you're actually going to come into a formal arrangement. You're going to trade as one entity probably, and that you are basically partners. There's been a lot of successful mergers that have gone on over the years, but there's been a lot of unsuccessful ones as well. So we don't have a lot of time to do this, and you know, it might mean that you've got to do this in the next few months. So you've got to make sure that you're going to get in bed with the right person, because they're going to become your business partner. The other thing you might like to consider is to, instead of being able to downsize or collaborate, you might like to consider to start to acquire. Now, that's been a very good strategy for a number of printers over the years. They just continually acquire to be able to build up their sales base. But again, we don't have a lot of time to be able to do it. And generally the professionals in this area will have a look at maybe 4 or 5 different firms before they actually make a decision as to which one they choose to acquire. So all of these choices here, and I'm not saying that these are the only choices, but all of these choices have got their fair degree of pain, in as much as that most of them have got to do with changing of premises or downsizing premises. So they might have something to do with your leases and about when they expire. It's also got to do with staff and staff redundancies. So yeah, there's a lot of things to consider. The other thing that you need to consider, of course, is the cost to be able to do these restructures. For example, people might have some negative equity in some of the plant and equipment, and specifically with regard to the digital plant. The digital plant, a lot of that is on rental agreements, and it's very hard to get positive equity in a rental agreement once it comes time to sell. You've also got to factor in, obviously, the staff redundancy costs. So we've been through the regroup stages and talked about being able to right size or being able to collaborate, etc. But some people will actually come to the stage where they don't have the cash, or they don't have the ability to change, which is very, very common, because it is a major change that people need to make. It might be easier and it might be better in the long run to be able to sell now. And with regard to selling, I mean, for the business owner, it may well be that they, after the sale has gone through, their key staff can move over to the other firm, and also they can also move over to the other firm, and they might have another job for another 5 years. Because generally speaking, what people want to do once they buy a business or they buy the goodwill of a business is they want to make sure they keep the sales, and to do that, usually they need to keep on the proprietor for a period of time. So just briefly, I just wanted to talk about what the values of businesses were prior to COVID. So there were two ways to do it. One was as a multiple of earnings, which means basically in very broad terms that you've got a profitability and that you apply a multiple to that profitability, and then you come up with a business sale price. The other way is to be able to sum up the assets, which is the sum of the plants and equipment and the sum of the goodwill. So you compare both of those. So there's no doubt that the multiples have decreased over the COVID period. And the reason for that is that there's a lot more risk involved in being able to buy a business now, because the buyer doesn't really know what the sales are going to come back to. They don't really know what the profit's going to come back to. So there's a lot more risk in buying a business of any sort now compared to pre-COVID. So the multiples have come down. The plant values have also come down, and I'll talk about that in a couple of points. But what is good is that basically the goodwill is keenly sought after. People want more sales, so they're very keen to buy the goodwill of businesses at the moment. But now most of the valuations are done on the second method, which is the sum of the assets. So that's the sum of the goodwill and the plant values. So I'll talk about each of those. With regard to the goodwill values, well, the goodwill values were previously based on a percentage of turnover. So if you had a $3 million business, it might be that the goodwill value of that business was 10% of turnover. So that equals $300,000. However, now we don't know what those sales are going to be. So the $3 million business is now only turning over $2 million. So what do people pay for those now? Well, the answer is that they probably pay a certain amount of money up front for it. So they might pay $100,000 up front and then give you a percentage of turnover as the sales come in. So that means that if you continue to turn over the $3 million, you end up with the $300,000. But if you only turn over $2 million in that period, you might only end up with $200,000. With regard to the plant and equipment values, is that it follows the supply and demand curve. So basically what we're finding, and what I think we'll find, is we'll find a lot more supply of used equipment in the marketplace. There'll be a lot more gear out there, and because of that, the prices will fall, but also there'll be a lot less demand for it as well. So people aren't putting their hands up now and saying they're keen to be able to buy older plants and equipment. So I think that the values of plants and equipment will decrease further over time as more people either merge or collaborate or downsize or close. That will bring in more plant and equipment, but the demand won't be there, so the prices will come down. So there's a whole range of ways that you can dispose of plant. You can do it through dealers who will pay you the wholesale value. You can do it with someone like myself with a used equipment classified site, printmachinery.com.au, or you might choose to go to auction. So then you've got to ask yourself that if you're considering going down the business sale path, when's the right time to sell? Is it the right time to sell now, or is it the right time to sell in 12 months' time? Well, a lot of it's got to do with what you forecast your sales to be, and if you've got a profitable business. As I said before, I think the values of the plant and equipment will continue to fall. So you're better off, if you're thinking of selling from a plant and equipment point of view, perhaps to sell now as opposed to later. And then you've got to have a look at what's happening to the sales. So go back to the example that I gave before about the $3 million turnover firm. You know, based on the survey or, you know, the poll that we just ran, we're going to continue on down the path of 20 to 30% less sales. Is it better to sell now or is it better to sell later? And the other part of that equation is that it's also about the debt level, because what you end up with in your back pocket when you sell is the net business value. So you end up with the business sale price now, and then you also end up with the debtors that you had at the day of the transaction and the cash in the bank that you had at the day of the transaction. But you've got to take off from that the payouts to the creditors, such as the staff entitlements and the loans. And if those are building over the next 12 months, then your net figure that you're going to get is going to be less than what it is today. So I'll now pass on to Andrew, who's going to talk about the closure option.
Thanks, Richard. So sometimes the unfortunate circumstances of life might mean that you do have to look at closing or restructuring. I stress that you're not on, if you're looking at those options, you're not on your own at the moment. There's thousands of businesses facing the same issue at the moment. So don't think that you're a failure or doing this. This COVID-19 scenario has got a lot of people, I found a lot of people wanting in certain circumstances through no fault of their own. So it may only be the viable option is to either close the business or look at a form of external administration, whether that's a voluntary administration to DOCA, which is a restructuring plan, or a liquidation, which is more a fatal, finalised plan to close the business down. So with the VA, voluntary administration to DOCA, is where a proposal can be made to your creditors in full and final satisfaction of their claims. Yeah, the proposal can be quite flexible. It can involve a cash injection coming in from the business owners or shareholders. It can involve a partial sale of the business or some of the hard assets, or even a sale and lease back of the premises to inject cash in, or it could be out of future profits, or a combination of all that. So I stress, if someone's looking at injecting significant cash into their business to keep it afloat, that you consider the voluntary administration DOCA process, because there's no point throwing in $100,000 or $250,000 if it's just getting rid of the major creditors or the trade creditors, but leaving the ATO. You want to do a situation where you can deal with all creditors in one go. Sorry. Alternatively, if you've came to the decision that there's no way out, a liquidation might be the process that you might have to do, and that's a close down of the business. One of the positive signs of a liquidation, if there is a positive sign, we've been talking about redundancy costs and those of your staff. If a company goes into liquidation, if there's not sufficient funds to pay the staff their redundancy costs, there's a federal government scheme called the FEG scheme, or Fair Work Entitlements Guarantee Scheme, which the government basically steps in to cover the entitlements of all employees that are being terminated as a result of the liquidation. So that's unpaid annual leave, unpaid unpaid annual leave, unpaid wages, unpaid long service leave, plus redundancy and payment in lieu of notice is relevant. However, it doesn't cover unpaid super. So if you do have a significant liability for employees for their redundancy, as well as accrued leave, this might be a viable option, because at the end of the day, your employees are probably like your family, and you don't want to leave them high and dry at the if you have to close the business down. So look at that as a scenario if you do want to, if you do have significant redundancy costs. There's pros and cons on doing all the scenarios, whether it's a voluntary administration, liquidation, or just an orderly close down. It all depends on the facts, matters, and circumstances of each individual case. So that's where I'm suggesting that you seek professional advice early from a qualified advisor. someone that's qualified in restructuring and turnaround or insolvency, someone that's a member of ARETA, the Australian Reconstruction, Insolvency and Turnaround Association. All the directors of Rogers Reedy are members of that. If you don't know someone from who is a member of ARETA, your accountant or solicitor should know someone. Make sure they are qualified, because there's a lot of pre-insolvency advisors out there providing a lot of unusual and potentially dodgy advice. Recently, there's been a lot of media attention on phoenixing, and several directors and advisors have been arrested. So if it sounds too good to be true, it probably is. And there's no harm in getting a second opinion from someone if you are uncertain about the advice you're getting, because you want to do it properly, you want to do it correctly and legally, and you don't want to be in a situation where you've done something and then it comes back to bite you on the bottom because it's turned out it's illegal and potential facing criminal proceedings. So if you are looking at closing down, that's one thing. But if you're looking at restructuring and allowing a new business to come through, or to transfer liabilities over, but leaving the ATO behind, they're a no-no. Get advice from a qualified advisor who's a proper member of an organisation and also has appropriate insurance in case it does go pear-shaped. So don't rule out an external administration. It's not the ideal scenario, but it happens to thousands of people each year. I often have people coming to me saying, I wish I did this 6 months before or 12 months before, because it would have saved me a few grey hairs, stress on my marriage, financial drain on my personal financial position. So often biting the bullet earlier is better than waiting for some creditor to take action, or you find out that the hole's too big to get out of in 6 months' time, rather than trying to act now and acting on the early warning signs rather than when it's fatal. So get advice from your accountant, your lawyer, and if they can't provide assistance, speak to someone like myself.
Okay. We're just about at the end, so you might like to summarise there, Andrew.
No, that's basically what I said before. Consider your mental stress of running through an uncertain time, and especially uncertain financial times. Not only the mental stress on yourself, but your family, your partner, and also those of your employees. A lot of your employees they can see what's happening in the business, and they're worried about their own job security and what's going to happen. So seek advice early, whilst hopefully there can be a turnaround situation in a restructure from a qualified advisor. But if not, know what your position is, your legal position, and what are your options, and then you can make an informed decision from there.
Okay, we'll throw over to you, Wade.
Look, I can only recommend that you use the knowledge of a finance broker when you're dealing with equipment finance or banks. We don't cost anything to you. We're paid by the banks, so there's no downside to it. Our knowledge of what to provide to the banks to get you what you want is far superior to yours. Use us. Anyone wants to have a chat with me, ask me any questions, just Google Wade Oldham Finance and you'll find me pretty easy.
Okay, thanks, Wade. Yeah, look, I think in my final summary, I think that we've just got to confront the facts. You know, they're not great. They're not great for a lot of printers out there. We understand that, but they are the facts. We can't change the marketplace. We can't really forecast the sales to any great degree of certainty. So we need to have a look at the best case and the worst case scenarios. You need to have a look at the different options. Now, I've been through quite a few options with you today, as have the other guys, but you need to explore those and have a look at what each one means to you and what's the best for your personal circumstance. And then when you come up with a plan, you need to seek a reality check. And by that, I mean you need to bounce it off somebody who's qualified to be able to give you some form of advice on your plan. Because if your plan is that you think that things are going to go back to normal, well, then I'd argue that that's not really a plan. That's just really a hope. So you've got to have a look at what the market facts are. So that pretty much sums up what we've gone a little bit over time. So apologies for that. What I'll do now is I'll address the questions that people have been asking during the presentation. So let me just go through some of those. First one is I missed the first half an hour. Can I still watch it? The good answer to that is yes, I will load this presentation up on my website, and it'll also be on the Visual Communications website on their trade show website as well. I've got one here. Richard, would you advocate more a lower cost walk-in, walk-out sale given these uncertain times over a deposit and a percentage of sales? New owners can make bad decisions, and they do that often. Yep, that's a very good question. The walk-in, walk-out scenario that has been asked is about when you just basically hand over the keys back to the purchaser. The pro with that is that you can get on with your life and you can move on. The con on it is that you're probably not going to get the value for your sales because people are going to pay you for the current sales level. So going back to my example, if you were doing $3 million worth of sales, then and you're currently doing 2 mil of sales, they'll pay you on the 2 mil of sales as opposed to the 3 mil. So you might not get the upside if it does turn around. And yes, there have been a lot of bad decisions made when you get in bed with people on those sort of arrangements where you get payment over time. You need to make sure that you're getting in bed with the right sort of the right sort of person. And a lot of that risk is reduced if you're actually working with the business as well, because you can actually see the sales that are going through the business. The next question was, if your BAS is based on cash not accruing and you have high income due to sales invoices prior to April not being paid until the June quarter, this does not show as income of being less than 30% for JobKeeper, even though some sales during the June quarter are down by 30%. How does this reflect on anything for the JobKeeper? How does this reflect on qualifying for the JobKeeper? And part two, to continue to qualify for JobKeeper, is the June and September combining meeting 30% average of the two quarters, or are the quarters measured separately? Okay, so I'll see. Yep.
I might answer that one, Richard.
Oh, good. All right.
The first one with the cash and accruing. So under the JobKeeper, you could either choose one quarter, the June quarter, or you could have chose any 1 month over the next 6 months to show that there was a 30% downturn. So in that case, you'd be looking at a monthly scenario if your March sales were high but the cash wasn't coming in to the later ones. So you could choose either April, May or June to qualify for that time, or even, I think the ATO allowed for a later time, but you weren't entitled to the payments until you made that election. So you should have still been eligible for JobKeeper, even though your cash was coming in, as long as it was compared to the previous year. So you would have looked at probably the month of June rather than the month of April one would look at. And for the second part, about to keep qualifying for the for JobKeeper post September, whether it's a 30% average on the 2 quarters or each quarter measured separately. My understanding is each quarter measured separately. So those businesses that have been able to overcome and survive and back to business as normal won't be eligible. But if your September quarter is still down, you will be eligible for JobKeeper moving forward. So if you had 60% down in the June quarter and only 10% down in the September quarter, unfortunately, you wouldn't qualify post September.
Yeah, no, look, that's right. It's pretty in what the government's actually put out. They basically say that it's got to be in the quarter. So that means that you've got to be 30% or more down in each of the quarters to qualify. We'll go back to the next one. Wade, as you know, a lot of digital equipment, if not most, is sold on a finance basis, including TCO, with the minimum clicks. With some businesses down in volumes as much as 80%, it would mean they are paying for nothing. How are financiers and suppliers dealing with the click-based finance deals?
You're a little bit out of my league on that because I'm financing an asset on the asset purchase, which is not relevant to the click rate. The click rate may be pertinent where you've done a finance or an operating lease rental with the vendor, such as Konica Finance, Canon Finance. They're actually a competitor of mine because most people will take the easiest option of saying, well, yeah, I'll have one, I'll have that unit, and I've got a heartbeat, you'll finance it as well, thanks, where do I sign? Unfortunately, it costs them in terms of effective interest rate by taking up the rental option. Also locks them into that vendor because you never know what your payout or how to get out of that machine. And the problem with rental agreements is like you rent your premises. As soon as you sign it, you owe every month until the end, and there's no rebate for getting out early. Where you finance a machine on a chattel mortgage or a commercial loan, there is a rebate of interest when you want to get out of that machine. As far as the click rates go, my only exposure to those has been with my customers where they're negotiating the click rate as a separate item to the purchase of the machine.
Okay.
That answers your question, but that's what I know.
And the next question's for you, Andrew. You can read that if you like.
Yep, so I'll just put that up. Andrew, another print company in liquidation this week, EPM Queensland, according to the ASIC site. Do you have any comparison numbers for print media businesses versus all businesses as far as liquidations or administrations are concerned? I don't have any comparative numbers for the printing industry compared to other industries or on the total. I do note, though, however, that the printing industry has been an industry on decline for a period of time, especially with changes in technology and demand. And so it has been an industry that has been coming up on the higher end of the companies going under as a percentage of total in that industry for probably the last 10 years, if not longer, probably longer. But I don't have any particular stats at the moment on that. So I can't answer that question exactly, unfortunately.
Okay, we've got another question coming through for you, Wade. Hey, Wade, what about Heidelberg's new way of selling on usage? Is it like a click in your view?
Absolutely.
I see you smile there, Wade.
Yeah, absolutely it is. I mean, again, it's vendor finance. I mean, look at it this way. Heidelberg is a manufacturer. It is not a bank. it's going to need to raise the funds to on-lend to you to finance that press. So there's a few mouths to be fed in there between where Heidelberg acquires it and you use it. Naturally, the interest rate's going to be higher as a result, and really there it's a ditched effort to be able to sell a machine. A bit like you walk into you have, well, case in turns, Lexhibition, where you go and buy a Lexus and they'll finance it at 0%. Sadly, not the case. There's an internal rate of return that they fiddle with to make it look like it's 0%, and you walk away with a car thinking you've got the deal of the century. Same with vendors in the line of your operating lease or click rate charges of all the vendors. Heidelberg have got one now. It's going to cost you.
I might also add, Wade, that's common in a lot of industries, and it's not only getting a sale away, but then locking them in for the consumables and the maintenance contracts, where they do make some big money out of whether that's automotive, printing. There's a whole heap of industries that do it.
Yeah, agreed. Yeah.
Okay, well, we've come to the end of the questions. So on behalf of the three of us, thank you very much for your attendance. It's been great. You'll see here that we've got our contact details on the screen. If you need to get in contact with us at any time, we'd be only too pleased to answer any of your subsequent questions. And that pretty much wraps it up. So thanks for attending, everybody. Appreciate it.
Good afternoon.